Thanks for tuning into this very special conversation on the Mutual Fund Show. Now, why this is important is because about 7 to 10 days ago, if I'm not wrong, an announcement caught everybody's attention. Now, the release was that Kotak Bluechip Fund celebrates 25 years of long-term wealth creation for investors. Now, while this is commendable that a scheme has completed 25 years, what also stood out for me really, or what really stood out for me, was that this has happened at a compounded annual growth rate, or CAGR. Some people understand CAGR now a lot more than compounded annual growth rate. It's a period of acronyms, isn't it? So the compounded annual growth rate of 16.36% for an SIP into that fund. Viewers, 16.36% over a period of 25 years can make you wealth like very few options in the world can. And therefore, we thought it best to welcome in the architects of Kotak AMC currently to talk about the history of this fund and what is it that mutual fund investing could do to wealth creation. The gentlemen need no introduction. Nilesh, Shah, Harsha, Upadhyaya join us on the show. Gentlemen, both of you, thank you so much for joining in. Nilesh bhai, in some sense, this is stuff that dreams are made of. People who would have been invested in this through the years would have been thanking their stars, and people who might have missed out on this because they got out too early or switched their investments, I hope they've done well too, but they will be ruining their luck that why is it that they didn't stay invested for the long term? The power of compounding.
So, Neeraj bhai, thank you for having us over here. And it's a matter of great pride when you see a fund completing 25 years, doing well in securing financial freedom for its investors. At the same time, it is also a time for introspection. How many people have stayed invested for full 15 years? It's like we were running a train from Mumbai to Delhi, and people were getting in at Mumbai Central, getting out at Borivali, getting in at Borivali, getting out at Palghar, getting in at Palghar, getting it out at Surat, and so on and so forth. I think still there is a need to make people aware that, like that story of tortoise and hare, in the end, tortoise wins the race.
Yeah, most certainly. But in some sense, and I'll get Harsha into this conversation for that purpose as well, but just an opening thought from you. Very often, the tenements of a scheme change with changes of fund managers, changes of people at the helm, the change in the policy that an AMC might have as well. 25 years, very few schemes would have had this longer runway, right? Were there some basic things that stood out for a scheme like this for it to be able to do so well, so consistently over such a long period of time?
So one, Neeraj bhai, we are standing on the foundation laid by, my previous employees at Kotak Mutual Fund. They build a foundation on which we are building it further. Second, Harsha has been in this company for now more than a decade, and he's steering our investment process. Every day you have to learn, but in terms of principle, we are rock solid. We'll buy quality companies. We will pay respect to the valuation. So we are nor growth at any price investors nor value investors. We are growth at reasonable price investors. Third, every decision we take, there is a research behind it. Now, sometimes it works. There are times when it doesn't work, but fair enough. Those principles lay the anchor on which funds are managed, and which is why, of course, there are rough patches, but overall, we still end up reaching our destination.
Harsha, come in on this one. Before I come to what the fund could do as well, and for you steering this fund now amongst everything else at Kotak in terms of equity strategy, but what does it take for a scheme to do this for such a long period of time?
Neeraj, as Nilesh mentioned, we have stuck to our investment discipline. I think that's the critical thing. People have come and gone. There will be changes even going forward. But as long as there is an institutional framework and people stick to it, I think the experience is going to be reasonably strong. In this fund, although the name has changed over a period of 25 years, it started as Kotak 30, as many people would have known at that point of time. Then we called it Kotak 50, and now it's called Kotak Bluechip. But the investment philosophy has remained the same, that we will invest in leadership companies, established companies, large cap companies. Even before the recategorization, we were investing more than 80% in the large caps, and that continues even now after the recategorization. So to that extent, the investors have not seen any change in investment philosophy or the discipline over the last 25 years, and continues to be very, very strong. We look at established leadership companies in each and every space and try to assess the business in terms of where is the competitive advantage, whether the company can sustain that competitive advantage for the next few years. Is it a scalable opportunity or not? How is the management? Is the management bandwidth good enough to steer that company into a next level? And then finally, the final filter is always valuation. So we have always been following this approach, and that has paid dividends, I would say.
The cornerstone of most conversations in the recent past, and you could argue, Harsha, maybe at times rightly so as well, that it's become difficult, increasingly difficult, at least in the, say for the last 12 months otherwise, for large cap funds, active funds, to beat the benchmarks very, very convincingly, and hence this whole rise of the debate around whether on the large cap category is passive ETF investing a better way to go to. In such a scenario, this fund has done what it has done for so consistently. Just trying to think about as the base has grown, as the performance benchmarks have been set, etc., how difficult or how easy would it be for you and Kotak AMC to now do an encore, possibly, of what you've done over the last few years into the near future?
See, that will always be our endeavor. See, as the size grows, as the market matures, it becomes challenging to create the same kind of alpha that we were possibly creating a decade earlier or 2 decades earlier. But having said that, there will always be cycles, whether it's a large cap fund, mid cap fund, or a small cap fund. Every active fund will go through cycles, and the businesses also go through cycles. And end of the day, the portfolio is a mix of several businesses, right? So to that extent, alpha creation can also be cyclical. Maybe in the past, the cyclicality didn't exhibit itself so often, but now markets having got more mature, more institutional money chasing the same set of stocks, etc., probably those cycles are quicker ones. Nevertheless, over the last 25-year period, the fund has beaten Nifty 50 by almost 3 percentage points. So you can imagine every year 3 percentage point outperformance for 25 years. Yes, in those 25 years, there have been periods where it has underperformed as well. But what remains to be understood is, if you are sticking with a fund for a long period of time, there will be periods of underperformance, outperformance. But if the investment discipline and the investment philosophy is robust enough, then the investor is more likely to get a good investor experience.
Nilesh, you want to add to this?
So as Harsha mentioned, there will be cycles now because our size has become big. I'm now no longer running a speedboat, I can take sharp turns. I'm now running oil tanker. If I have to take a U-turn, I'll still move 2 kilometers further and then take a U-turn. But eventually, will there be a place for professional fund manager to add value to the customer? We believe answer is yes. And this is when there is a non-level playing field. For example, a fund is kept at 10% in an investment in a stock. Index is not. Second, in index stocks, enter and exit at the closing price. Fund has an impact cost. Third, we are comparing total return index vis-a-vis net performance of fund. Globally, people compare gross performance with TRI. Despite those challenges, will we be able to add value? Answer is yes.
Got it. I'm glad you're not navigating the oil tanker through the Red Sea currently, as the case may be. But
so, Neeraj bhai, will there be periods when we will go through Red Sea? Answer is yes.
Yes, most certainly.
For a time like today, when so many low floating stocks has gone up substantially, there's tremendous pressure on us to go and buy those momentum stock because our funds are not performing. We are underperforming benchmark indices. If I didn't bother about my investors, I'll go and invest in those momentum stocks. But we have a process. We'll have to bear the pain of underperformance for a while. because hopefully eventually we will be proven right.
Yeah, and we'll talk about this on the other side as well, because there is a market goes through those cycles. But just a sneak peek into what we'll talk after the break, and both of you can quickly weigh in on this. But just wanted to understand, he mentioned momentum and how in some cases currently momentum is really beating or taking the pants off what could be considered conventional forms of investing, right? But it may be a cycle. I mean, are you guys of the belief that that is the kind of market we are going through right now? And while difficult to preempt when it will end, but it is a cycle that will probably see its course, and eventually what has held the age-old wisdom of investing will probably come back in flavor as well?
Definitely. I think end of the day, there has to be an earnings support, there has to be a fundamental support for stocks to reach certain level and sustain those levels. If they are going without support of fundamentals, or for the reason that there is lack of liquidity and hence a small amount of money is driving those stocks, I don't think that's sustainable over a period of time. Sometimes it takes few months to see that cycle going down. Sometimes it takes longer. So, but finally the earnings have to support the growth. That's what we believe, and that's what has been proven even in the past. And I'm sure that even going forward, that's going to exhibit itself. Okay.
And market-wide, just before we take that break, Nilesh bhai, market-wide, either of you can come in, of course, but we've been talking a lot about Indian valuations and how expensive they are optically, etc., and stuff like that. Question is, do you guys, based on your research, your analysis or your assessment of the earnings commentary from companies for the last 3 quarters or otherwise, believe that earnings growth is in reasonable fine fettle to justify the kind of exuberance, if you will, that the market is in? Harsha?
If you look at not just the last 3 quarters, but if you look at from the COVID lows, the market earnings have grown at a CAGR of in excess of 30%, and even markets have given more or less similar kind of returns. So to that extent, if you simply look at last 3 years, this doesn't seem to be out of whack. This seems to be more or less in line with what the earnings growth has been. But the question is whether the same kind of earnings growth can continue for the next several years. That is only, in that case, the valuation can sustain. But if there is a moderation in earnings growth going forward, then certainly there will be some hiccups along the way.
So for now, we are predicting, or we are basing our valuations on the belief that this earnings momentum will sustain, right?
The market is basing
it. Market is, yes. Okay, fine. What truly constitutes now components of a blue chip fund under the current scenario? Because the number of sectors that have come to the fore, the number of spaces which may not necessarily have the true blue Nifty 50 presence, but are large sectors in their own right. So how does the fund constitution now become relative to what it would have been in the past?
I don't think anything has changed because even earlier when the categories were not clearly demarcated in terms of the asset allocation pattern, we were investing more than 80% in the large cap stocks. Even today we are investing in more than 80% of our corpus in large cap stocks. The rest of 20% is available for you to invest into mid and small caps wherever you believe that there is an opportunity. Within the large cap space, it's equally split between Nifty and non-Nifty, which is the Nifty Junior as we call it. So the top 50 and the bottom 50 within the top 100 companies have more or less a similar kind of exposure in the fund. And it has exposure in a very, very diversified manner within the large caps. Almost all of the large segments of the market are represented in that. We do have a tilt towards domestic businesses today. Given that the global-facing businesses or the export-oriented businesses have some headwinds as we see going ahead. And India growth has also been more robust and resilient as compared to global growth. Yes, valuation in pockets have been expensive, but as you would know, the large caps don't have that valuation risk as much as mid and small caps. So we are well diversified within large caps, having a tilt towards domestic businesses. And the rest 20% goes into mid and small caps, where we will go sector agnostic and look at bottom-up opportunities.
Nilesh bhai, you've been at the forefront of talking about the innumerable number of new opportunities that India as a country has gotten as well. What do you anticipate the large cap space to be like as well over the course of the next 5-7 years? Because like I was saying, not everything finds its way into the Nifty per se, quote unquote, right? It's fashionable to quote about Nifty 50 or Sensex 30. Not everything finds its way there. So what do you think, or how do you think the constitution of the large cap universe in India will be like relative to what it is currently?
So one, Neeraj, there is a trend where innovators and disruptors will do well. At at one point of time, Mumbai, Gujarati, Marwadi equal to stockbroking. Today, top 2 stockbroking company of India is not based in Mumbai. They are outside of Mumbai and they are a recent trend. What happened in stockbroking will happen in every industry. And as fund manager, if we can go and pick up those companies, that will be really good because they'll create tremendous value for investors. Now, will there be failures? Answer is yes. If you are innovator, if you are disruptor, you will fail. Today, Apple announced that they are pulling back from electric car.
Yes.
Someone can call it a failure. I will probably use Thomas Alva Edison's famous word that I haven't failed 1 lakh times. I found out ways of not doing that thing 1 lakh way. So, innovator, disruptor is the future. Will large companies be able to do it? Well, they have the wherewithal and resources to do it. But then they have to also remember that they don't become like Kodak. Kodak had all the resources to go into digital films, but they didn't. So essentially, you are trying to pick up companies which are investing for future, which are willing to forgo their present, reset for the future, and become an innovator stroke disruptor.
Where do you see these opportunities? Because they could form a part of the 20% of the Blue Chip Fund as well. They could form a part of a number of other Kotak AMC schemes as well. So to you and then to Harsha, where do you see such opportunities within India?
So today we have invested in an explosive company which is exporting explosives to the home of explosive inventor. We have invested in an auto component company which has become the first company in the world to get a contract of making engine spare part for Toyota. These are all, some small, some mid, some large cap companies who are doing innovation and disruptor. It's not that the big guys are not doing disruption or innovation, they are also doing. So essentially, you are trying to future-proof your portfolio by investing in companies which are ready to face the future.
Got it. Harsha, you want to add to this?
Neeraj, if you look through the cycles, the large cap profit pool has been around 75% of the total profit pool in the corporate world, right, in the listed space. So it's not that every time there is a new entrant, they are able to move into the upper bracket and they are displacing somebody who is already there. Yes, there will be cases like that in the large cap, in the mid cap, in every segment. But end of the day, these top 100 companies are the ones who have established, who have seen cycles, who have the bandwidth to really manage many of the adversities that may encounter over a long period of time. So you can't really ignore. So if you want stability to the portfolio, you have to have some mix of large, mid, and small because the opportunities will be all around. So I think if somebody is looking for a little more conservative equity product, a large cap product is definitely one of that. And that's how we have been managing this over a period of time. And over a period of time, the returns are as good as you would see in any other category. So for a long-term investor, I think the opportunities are there in every space of the market. And depending on the valuation comfort, we have the flexibility to move between sectors, move between market capitalization patterns. And that flexibility allows us to really manage the volatility and also the valuation risk, etc.
Yeah, but still, I'm just trying to get clarity on my question, which is, Harsha, that thank you for answering that. But where do you think the next set of big opportunities come in? Because like Nilesh bhai said, that one, companies need to invest for the future. So some of your top holdings, for example, are the traditional banks, maybe IT services, oil energy upstream company, the behemoth, etc. Where do you see in the remaining 20%, if you will, where there are opportunities wherein companies have a chance, the highest chance of maybe being small currently, relatively, but having the fighting chance of becoming larger over the course of the next 7 years?
See, if you look back, India has seen cycles of 5 to 8 years in businesses as well as in stock markets where a particular theme does well from a business perspective, right, and also gets re-rated over a period of time. Right? From the mid-90s to maybe 2000, 2001, it was the IT outsourcing theme, which did well in terms of business as well as in terms of how stock market reacted to it. Then there was a period where construction, infrastructure-led activities really drove the growth, and also the stock market really kind of re-rated the entire basket. Then we had 2 periods where consumption-oriented theme as well as banking were the next two big themes. Now we believe that over the next 5-7 years, manufacturing, when I say manufacturing, it will cover all gamuts of manufacturing. I think there is really a wonderful space where India can occupy a part of the global trade. There are geopolitical issues which are favoring us, and there is capability building that's happening, which will also allow us to really go and compete against many of the competitors in the world. And definitely, I think the policy push is also towards making sure that India comes out as a manufacturing hub. So there will be several plays within the manufacturing which will give that kind of attractive growth over the next few years in our mind. And that will be represented both in large cap segment in the 80% as well as in the 20% outside the large cap.
Got it. Okay. Final question, Nilesh bhai. And what is the one thing that, as a CEO of this firm, and as somebody who's doing countless these seminars, meeting investors, the one message that we want to give to mutual fund investors currently, something that you believe they should be doing but are not doing? I would reckon one of the easy answers is not staying invested for long term. But still, is there something else as well?
So, in a slightly lighter wing, in our culture, we have been told that money is not everything in life. Money doesn't matter. Paiso hathno mel chhe. My recommendation is what Warren Buffett mentioned. Money is not everything in life. Money is not important, but make sure that you have made enough money before you make such statement. Please, please, please protect your financial security. For our parent, we were their retirement solution. But let's leave sar utha ke jiyo. Secure your financial freedom, and if you are faithful to that, mutual fund will be your top priority. Then by definition, you will become regular investor, long-term investor, and also a disciplined investor.
Well, I certainly hope people are taking cognizance of this. But gentlemen, congratulations to the fund house at large for such a wonderful journey of one of the schemes, and I'm sure there'll be many more during the course of its existence. And thank you for sharing such insights with us.
Thank you.
Thank you so much. And viewers, thanks for tuning into this very special episode of the Mutual Fund Show.